Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the financial world, and today we're looking at Fidelity Private Credit Fund. Get ready because we're about to see how they're playing with some serious dough, and it's not quite what you might expect with a name like Private Credit. And hey, before we dive in, if you are not already subscribed, hit that button. And if you want to chat about these filings or anything else finance related, join our Discord community, links in the description below. So what we have here is a Form 8K filing. Think of this as a current report from a company. It is filed when something really important happens that investors should know about right away. Fidelity Private Credit Fund is the company we're looking at. It's based in Delaware, and these reports are filed with the US Securities and Exchange Commission, or the CC for short. Now, the core of this report is about a change to a pretty big agreement. It is called an amendment to a credit and security agreement. Basically, they're tweaking the terms of a loan or a line of credit. The original deal was made back in December of 2024, and this is the first update, hence amendment number 1. This amendment was signed on the 7th of January 2026. Now, some of the key things they changed are pretty important for understanding how this fund operates and how long it can keep borrowing money. First off, they've extended what is called the reinvestment period. This is the time when the fund can actually go out and buy new investments. They pushed this deadline back by a full year, from December 2027 all the way to December 2028. This suggests they still have a lot of flexibility and appetite to acquire new assets. Even more significantly, they've extended the maturity date. This is the date when the loan has to be fully paid back. They've moved it from December 2029 to December 2030. That is another year of breathing room. For a private credit fund, longer terms often mean more stability and a chance to let investments mature. Now, let's talk about the cost of this money. They've also managed to reduce what is called the applicable margin. This is essentially the interest rate that the lenders charge above some base rate. Before the commitment termination date, the margin has been lowered from 2.30% per year down to 1.95% per year. That is a pretty good chunk of savings. Less interest paid means more profit or more money to reinvest. And even after that commitment termination date, they've also managed to get a reduction from 2.80% down to 2.45%. This indicates that the lenders are feeling more confident about the fund, or perhaps the fund has negotiated a better deal due to its performance or market conditions. In simple terms, they are paying less to borrow money, which is generally a very positive sign. This section basically just tells us that the credit facility we just talked about is a direct financial obligation for the company. It's official, it's a debt, and they are responsible for it. Nothing too surprising here, it just confirms the nature of the agreement. Now, the really detailed stuff, the actual legal document that spells out all these new terms, is filed as Exhibit 10.1. We can't go through every single clause here, but this exhibit is the source of truth for everything we've been discussing. It is where all the nitty-gritty details about this loan amendment are laid out. The exhibit lists all the parties involved. You have Fidelity Private Credit Fund, CSPV LLC, as the borrower, the main Fidelity Private Credit Fund as the equity holder and manager, Citibank as the administrative agent, and State Street Bank as collateral agent, involving major financial institutions. And finally, the report is signed off by Heather Bonner, who holds the titles of President and Treasurer. This is the official confirmation from the company's leadership that this filing is accurate and complete. The date of the signature is the 12th of January 2026, just a few days after the amendment itself was finalized. So, let's wrap this up. What does all this mean? Fidelity Private Credit Fund has successfully renegotiated its main credit line, extending its borrowing ability and lowering its interest costs. This is a strong signal of financial health and confidence from its lenders. By pushing back the reinvestment and maturity dates, they're gaining more time to deploy capital and potentially generate returns. The reduced margins mean they're paying less, which directly boosts their profitability. This looks like a smart move to secure more favorable long-term financing, allowing them to continue their strategy in the private credit market with less immediate pressure and lower costs. It's a good sign for them, suggesting they're managing their debt effectively and favorably. Alright, that is our breakdown of Fidelity Private Credit Fund's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think these extensions are a sign of strength or a way to kick the can down the road? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into corporate finance. And remember, for more discussions and to connect with other finance enthusiasts, check out the Discord community link in the description. Thanks for watching, and we'll see you in the next video.